Let's say an example on consolidation. In this case, P acquired 60% interest in S on 2nd of January 2001. So on that day, that is the day of acquisition, the subsidiaries' share capital and retained earnings were 80,000 and 30,000 respectively. We do not find any other equity item, so we assume that this is the only equity item. So share capital is 80,000, retained earnings is 30,000, altogether the total equity 110,000. If there is no other equity item, net assets minus liability is always equal to equity. Therefore, the book value of the net asset on that day is also 110,000. We have been told that the book value at the day of acquisition will close to fair value. Therefore, for this example, there's no fair value adjustment, no need to revalue the assets because the book value is the same as the fair value at the day of acquisition. We have been told that the fair value of non-controlling interest at the day of acquisition was 75,000, so it is 75,000. So our current policy is to recognize this non-controlling interest at fair value at the acquisition day, so we will use the full GUIL method. This is the situation on 31st of December 2008, which is many years after the day of acquisition. Every year we have to prepare consolidated financial statements, so this question asks us to prepare consolidated financial statement on 31st of December 2008. Let's see the situation. So we start to calculate the goodwill. As I've said before, we use fair value of non-controlling interest at the day of acquisition. Therefore, we will use the full GUIL method. So first, we calculate the consideration transfer. The question did not tell you how much we pay in the information, but we found in the parent's own book, there's an investment in subsidiary. Investment in subsidiary is 117,000. Actually, the parent can put the investment in subsidiary at cost or most likely fair value full profit and loss or fair value full other comprehensive income. But for this question, we have not been told anything about the fair value. So therefore, the only thing that we can do is to assume that this is the cost of investment. Cost of investments means the consideration transfer at the day of acquisition. The fair value of the consideration at the day of acquisition, 117,000. Non-controlling interest will be stated at fair value, so 75,000. So I pay for 60%, non-controlling interest contributed for 40%, altogether 100%. This is what we pay. What we pay minus what we get, as we have said before, at the day of acquisition, share capital 80,000, retained earnings 30,000. We don't have any other equity items like revaluation reserve, general reserve, other reserve, transition reserve. So this is the only equity. Equity equals to net asset at the day of acquisition. We pay 192,000. We get net asset 110,000. So the goodwill is the difference between what we pay minus what we get. This is 82,000. We will use full GUIL method. The partial GUIL method is given only as a reference. Now we start our consolidation journal entry. So basically, we credit investment in subsidiary. So we credit away the investment in subsidiary that we found in the parent's own book. We credit non-controlling interest. We establish this non-controlling interest at the day of acquisition. This is actually what we pay. What we pay will be compared with what we get. What we get at the day of acquisition was, we have got share capital. So we debit away the share capital of the subsidiary at the day of acquisition. We debit away the retained earnings at the day of acquisition. There's no fair value adjustments. So this is what we get at the day of acquisition. So what we pay minus what we get is goodwill. Goodwill is a balancing figure, surely exactly the same as what we have calculated. Now we continue. The first journal entry only gives you the NSI figure at the day of acquisition, but we have to update the NSI figures up to now. So we follow two steps. First, from the day of acquisitions up to the beginning of the current year, and then later for the current year. At the beginning of the current year, always we share only the profit of the subsidiary, so never share the profit of the parent, right? So we share the profit of the subsidiary to NCI. So from the day of acquisition, we know that at the day of acquisition, the retained earning was 30,000. It was 30,000. Now it increased to 38,200 at the beginning of the current year. So from the day of acquisitions up to the beginning of the current year, retained earning increased by 8,200, 40% share to NCI. Therefore, we debit retained earnings and we credit non-controlling interest, being the share of the profit from the day of acquisitions up to the beginning of the current year. After we share the profits from the day of acquisition up to the beginning of the current year, we share the current year profit. From the subsidiaries' financial statements, we find the profit for the year, which is 42,000. So we share 40% to NCI. Therefore, we debit profit to NCI and we credit NCI, being the share of the profit for the current year to NCI. We have shared the profit from the day of acquisitions up to now already. So this is the share of the profit to NCI. But we found that actually this subsidiary has paid out a dividend for the current year. Dividend paid only from profit. Because we have already shared the profits to NCI, dividend pay should not be regarded as a second source of profit. Therefore, always the dividend paid by the subsidiary during the current year should be eliminated. So we need to credit away the dividend pay because original balance is a debit. So we credit away the dividend pay. So out of this 31,500, 60% must have been recorded by the parent because the parent can record 60% of the dividend paid by a subsidiary. So in the parent's own book, they must have got a dividend income. Dividend income is a credit. To eliminate means we have to debit away the dividend income that the parent has recorded. 60% goes to parent, 40% goes to NCI. So we eliminate also 40% for NCI. So we debit NCI 40%. When NCI share the profit, we have credited NCI. Right? So therefore now, when we pay dividend to NCI, NCI should go down. So 60% parent, 40% NCI. We can put all this journal entry into our worksheet. Just a typical worksheet. We input everything of the parent here. We input everything of the subsidiaries here. So basically we'll add them together. But there will be consolidation adjustments. We have prepared 4 consolidation adjustments. Now we just post this relevant journal entry into the adjustment section. Say for example here we debit share capital. So that's why we debit share capital here. We debit retained earnings. So therefore we debit retained earnings. We debit goodwill. So we debit goodwill. We credit investment in subsidiary. So we credit investment in subsidiary. We credit NCI. Therefore we credit NCI here. So remember to insert these NCI figures just before the total equity. The original parent's financial statements will not have this item, non-controlling interest, so we have to include it here. Also in the parent's own book, they don't have the goodwill, but we have a goodwill here. Goodwill is an asset, right? So we got the goodwill figures in the long-current asset. We got the non-controlling interest here as the last item before we total for the total equity. So if we insert this non-controlling interest here, so anything before it, these equity, retained earnings, share capital, actually only belongs to the parent. So that's why this share capital for the consolidated financial statements is also the share capital of the parent. Of course, right? Because to whom we prepare consolidated financial statements, we prepare consolidated financial statement for the shareholder of the parent. The investment in subsidiary will always be fully eliminated. It must be zero. We got the goodwill here. We got everything. If there's no consolidation adjustments, we simply add everything together, 100% of the parent and 100% of the subsidiary. So for asset, liability, we simply add them together. For equity, we separate into two sections, right? The above is for parent, one item is for NCI, and then we got the total equity. We balance our balance sheet, therefore. If the question asks for also consolidated income statements, so we will prepare the consolidated income statements as well as the consolidated statement of retained earnings here. So we input only the relevant item here, say for example share capital, retained earnings, goodwill, investment in subsidiary, etc. There's no balance sheet effect except for the retained earnings, which will be included under retained earnings here. So therefore, when we debit retained earnings, we debit retained earnings. The other four, we don't have any impact on the statement of retained earnings and comprehensive income. So here for debits to the retained earnings, we input here. For profit to NCI, we input here. For dividend income, we debit dividend income. For dividend pay, we credit dividend pay. So only 5 items actually affect the statement of income and statement of retained earnings. 2 items affect the statement of income. 3 items affect the retained earnings. Anyway, if the question asks for the statement of retained earnings and consolidated income statement, this is what we have to do. Strictly speaking, you can post this 151,220 as the closing retained earnings to the balance sheet. Right? So if we have got these figures from the statement of retained earnings, we don't need to repeat these 5 journal entries that we have input in the statement of income and retained earnings. Right? So here we input these 5 items here, assuming that we are not going to prepare the income statement and statement of retained earnings. If we are going to prepare the full set of financial statements, basically you can copy this 151,220 from the statement of retained earnings and income, like here. Right? So no need to post twice. Right? So here I post twice, just assuming that we don't prepare both statements. Right? Anyway, if you post twice, you've got only marks for one time. Now we have got the non-controlling interest here. Non-controlling interest is an investment value. Just like my investment in Hong Kong Bank, always my investments consist of 3 components. The 3 components are the share of the book value of the net asset, the share of the fair value adjustments, and the share of the goodwill, actually. So the first component is the share of the book value. Book value. From the financial statements, we know that the equity of the subsidiary is 128,700, the latest one, the update figure. You can calculate also using assets minus liability. So assets 294,700 minus liability 166,000 will always be the same as the equity figures. So the net asset is 180,700. So 128,700, we share 40% to NCI. There's no fair value adjustments for this example. So the last item will be the goodwill. Goodwill is the goodwill to NCI. Goodwill to NCI and goodwill to the parent may not be proportionate because what the parent pay will be different from what the NCI will be willing to contribute. So usually the parent may be willing to pay more in order to get the control, right? So that's why they may pay difference from some small shareholders will pay. So that's why it may not be proportional. So don't simply calculate a proportion of the goodwill as the goodwill for NCI. You have to calculate the goodwill for NCI. Goodwill for NCI is what NCI contributed at the day of acquisition minus what NCI gets. NCI pay 75,000 as the fair value of NCI at the day of acquisition. NCI get 40% of the net asset at the day of acquisition. So what NCI pay minus what NCI get is the goodwill for NCI, 31,000. So that's why goodwill for NCI is 31,000. Book value of net asset, fair value adjustments, and the goodwill for NCI is exactly the same as the NCI figures in our consolidated balance sheet.